Facebook Live. My name is Tate Anzalone, and I'm an enrolled agent with the IRS, and I'm the Member Experience Manager for Stride's tax product, Stride Tax. The Tax Cuts and Jobs Act was the biggest tax reform that we've seen in the past 30 years. The last tax reform was in 1986, and this past one was passed at the end of 2017, and there were a lot of changes that came with that. The Act put into place new regulations that affect all types of people and businesses and any kind of taxable entity, including self-employed workers. So if you're self-employed, Stride is explaining how the TCJA might affect you in a series of 3 Facebook Live videos. If you missed the first and second, you can find the links to them in the comments below this broadcast. So today we're going to be focusing on things that were eliminated with the TCJA and what they may mean for you as a self-employed worker. Now if you have any questions about what we go over today, you can comment your questions in the comments below and we'll get back to you after the broadcast. Be also sure to like this broadcast and share it so that all of your self-employed friends in your industry can get ready for the April 15th deadline. And we'd be happy to answer any of the questions that they may have as well. If you have a question, once again, drop it into the comments below so that we can answer it. And also feel free to follow us on Twitter and visit our blog if you'd like to see more information about any of the topics that we go over. So a couple items to take note of that were removed with the recent tax reform. So one, there's no ACA tax penalty. So since the 2014 tax year, taxpayers have been fined for not having health insurance, and that was part of the Affordable Care Act. So the tax penalty was called the individual mandate, and the mandate was repealed with the recent tax reform. So that means that you will no longer have to pay a tax penalty for going uninsured, starting with the 2019 tax year. So it's important to note that for the 2018 tax years, the taxes that you're about to file in April, you will still have to report your health insurance details, and if you went uninsured in 2018, you'll have to pay the tax penalty still. So another big change is there are no more personal and dependent exemptions. So before the TCJA, taxpayers got a basic flat rate deduction of $4,050 per person on their tax return. So these exemptions could be claimed for yourself and your spouse and any dependents that you may have claimed. So it's important to note that you can no longer claim these personal and dependent exemptions, but depending on who you are, so depending on your filing status and how many dependents you are going to claim, you may still be able to make that money back in a different deduction. So for example, these personal and dependent exemptions were claimed alongside the standard deduction. So for single filers, you could claim that $4,050 dependent exemption for yourself, as well as a standard deduction of $6,350 in 2017. So that's a total deduction for yourself of $10,400 if you claim your exemption alongside your standard deduction. So even though now you can't claim that exemption anymore, you have a larger standard deduction to claim off of your AGI. So that standard deduction for single filers is $12,000 for 2018. So that means that even if you can't take the exemption, your deduction off of your AGI may still be higher than it was previously. You could be taking an exemption deduction of $12,000 as opposed to $10,400. So that doesn't apply to everybody, but if you're a single filer, then it likely applies to you. So another change that you may see with the recent tax reform is no more alimony deductions. So for several decades, taxpayers have been able to deduct alimony payments off of their income, and recipients of those alimony payments had to include the money as part of their taxable income. So if you paid the alimony, then you could deduct it off of your income, and if you received it, you had to include it as income on your tax return. So as part of the TCJA, any alimony agreements that were entered into after December 31st, 2018, so any alimony agreements that were made in 2019 so far, the payer does not have to deduct the money off of their income, and the recipient does not have to include it as income. So the alimony payments are effectively not as relevant on your tax return as they were before. Thanks so much for joining us for the third and last video in our series on tax reform for self-employed workers. If you're looking for more tips or guidance and a recording of this Facebook Live video, you can follow us on Twitter and head to our blog so that you can read more details about any of the information that we shared today. And you can also find answers to your questions in the comment section below. Thank you.